welcome everyone to the next edition of the Unheated podcast, the ArcTern Ventures podcast. We are an early stage climate fund based in India, and we're excited to bring to you today Liza from Carbon Equity. Carbon Equity is a Netherlands based climate fund of funds platform for venture capital and private equity. Since its inception in mid 2021, Carbon Equity has enabled 400 plus investors to invest over 90 million euros across its various climate funds, specifically 7 to 10 private equity funds, and spread across 150 plus climate tech companies in sectors such as energy, carbon, buildings, transport, food and agriculture across the North America and European regions. Liza is a co-founder and head of impact at Carbon Equity, and previously she was a consultant with McKinsey and Company, specializing in energy transition, and an impact investing researcher before that at the Dutch Association of Investors for Sustainable Development. So, welcome, Liza. Thank you so much for joining us today, and really excited to speak with you in this conversation. So, to kick us off, I thought we could start with, one of the opening questions, which is, could you tell us a little bit more about carbon equity, the thesis, and the focus areas, and also as an LP fund of funds platform, what is the sort of specific criteria, the type of fund that you normally look to invest in, and how did you sort of come about with this idea to set it up?
Very happy to, and thank you for having me, Priya. It's a pleasure. There's a lot to unpack. So we started Carbon Equity really with the goal to help private investors put their money to use for solving climate change. That was a foundational thought, and we looked at all different financial instruments out there and which ones are best suited to do that. And we came to the conclusion it's really hard to have real impact in public markets because you buy the stock from someone else. Nothing really changes in the world because you buy that stock. And rather, it's the innovative companies, the startups, the scale-ups that need direct funding to grow their businesses. And we need a lot of innovation to get to net zero. So we're like, okay, it's early stage companies that really need the financing. But private investors typically can't invest well into those startups. So maybe they have a network, they can do some angel investments, maybe they do some crowdfunding, but to invest in that asset class in a professional way is very hard. The best people out there are the climate VC and PE funds, but those have minimum tickets in the millions, so are generally not accessible to private investors. So we were like, okay, there is this huge capital pool and a keen interest of private investors to invest for impact and invest in these startups and scale-ups. And then there's these funds that are very happy to accept more capital, but they don't have the time and energy to go and collect all of those small tickets. So we can be a middleman. So that's what we do. And by now we're almost at 200 million under management, actually. So we've been growing quite rapidly from over 700 investors. And I think you explained it very well. So we're a climate fund of fund platform. That means that our key product is an annual climate fund of funds program where every year we raise capital to invest into 7 to 10 funds. These range from pre-seed all the way to buyout, North America, Europe focused, all sectors, hardware, software. We try to create as much diversification, but really focused on getting to net zero. And next to that, we might start launching other types of fund of fund programs. Specifically, right now, we're looking at an infrastructure fund of fund because we also need a lot more money there. What else to tell? I think that's most important about our fund. Shall we move to the LPs? Like what we're looking
Yeah,
for as an investor? Yeah.
sure, absolutely.
So our investment team consists of, by now we're a team of 7
Mhm.
investing in the category. The 2 people who really set up the general due diligence both come from AlpInvest. So they take their view and experiences from there. And so when we started, we set a few safeguards in terms of what we want to invest in. So first of all, these are funds that are decarbonization focused. There's a lot of general impact funds out there, but we prefer to go with the decarbonization funds when we can. Secondly, we say generally a fund needs to be at least 100 million in size. And the reason we set that is that it's a way for us to make sure that funds are a little bit more institutionalized, broader set of investors. It's a way to manage risk for us. And third of all, just very ambitious climate investors. So investors that are willing to take the big bets. Our funds are more hardware and software focused, and we don't shy away from solving the big problems. Or we like funds who don't shy away from solving the big problems.
Very interesting. Thanks a lot for the background. So, with the funds that you select, are they sort of sector specific funds? So, would you have like a carbon only fund or a buildings only fund or an EV specific fund?
Yeah.
And what's sort of the sector that you think has gained the most amount of interest and traction with the fund in LPs and investors? Where do you think the larger opportunity they think lies?
Yeah, it's a very good question. It's not an easy one to answer. So yes, we invest in vertical focused funds. We're an LP in 2150, which is a urban built environment focused fund. We're an LP in Ascenor, agri-food focused fund. We've looked quite a bit, and actually we're an LP in carbon direct, so kind of carbon management, carbon capture removal, utilization focused fund. Typically, you see that I would say industry and energy go together, so they're kind of like multi-focused fund, but maybe not climate broadly. So those we also allocate to. In our fund, again, this is something that we try to balance. So there will be one or two vertical focus funds and then a few more generalists, and that's how we balance it out. And in terms of verticals, yeah, you do see changes. I think when we started deploying over 2 years ago, agri-food was very hot. There was a lot of demand. There were a lot of funds raising, a lot of big funds raised, a lot of big investment rounds into startups and scale-ups. And now that has gone a little bit more quiet. There are some challenges in the industry. Very much hoping we'll see some recovery there in the coming 2 years. And at the same time, you see, well, I think hydrogen, carbon removal, other things are picking up pace in par with policies in Europe and North America. But we are investing into GPs for 10 years. So while we're riding the waves in terms of which funds are raising and where we think valuations are attractive at the moment, we're also very much aware that we're long-term investors.
Interesting. And have any of your funds already seen exits in any companies? What is the typical exit route for a
Yeah,
lot of these businesses? And do they have any of the funds also completed? I know the platform was just launched in 2021, so probably you're still in the first cycle of
yeah.
these funds, and pretty much they must be all first-time fund managers. So how do they think about the exit route, and what do investors expect?
Yeah, it's a good question. So when you look at the data, exits so far are still majority strategic exits. I think about 60% in climate tech. Next to that, we have seen quite a few IPOs as well. And I think increasingly we're also seeing exits to big private equity buyout funds. Companies are being held longer privately is a general trend that we're also seeing in climate tech. In our funds, indeed, no big exits so far. There have been a few companies that were exited for other reasons, but wouldn't call those successful exits.
Right. And so, for these big strategic buyouts or these large PE or growth funds that come in, what are the normal, I mean, not normal, but perhaps what are the typical sectors which see this level of interest? Is it mobility or is it renewables? Because, yeah, just curious to understand more about that.
Specifically on the exits, yeah.
Yeah.
I'd have to look up the data. I actually don't really know. But I'm
Hmm.
seeing a lot of big rounds happening in a lot of different verticals, right? So in energy, we're seeing whether it's nuclear fusion or different kinds of geothermal. There's a lot of activity happening there. There's a lot happening in hydrogen. Thinking in industry, we see a lot of activity. In built environment, we see a lot of bigger rounds. Uh, I really think it's across the board. I think if there's one industry that I'm personally currently slightly worried about, it is agri-foods. I think it
Hmm.
has slowed down a little bit there. We have seen valuations come down. And also, when you zoom all the way out, I think the push drivers for agri-food are slightly less clear. So for all the other climate verticals, there's big increases in policy happening. There's big commitments from corporates to transform.
Hmm.
There's clear pathways to cost parity, consumer willingness to buy. And in
Hmm. Hmm.
agri-food, I'm personally just wondering where's the push going to come from? Because at least in Europe, we're much more conservative on our agri-food policies. I think that the frame that natural eating is better than synthetic has been quite powerful. And so at the moment, that is where I'm kind of like spending my brain power and trying to figure out what's the agri-food transition going to look like and what's going to be the drivers there.
And these technologies within agri-food, are they more around, precision farming, vertical farming? Are they around, potentially insect protein? What are some of the kind of innovations that are being worked on that are
Yeah.
seeing some
Yeah.
volatility perhaps in growth?
Yeah, volatility and growth has been, I think, vertical farming. We've seen a bit of a coming back to earth in terms of for how many applications that's really the more efficient, more cost effective way to farm. I think we've also seen a little bit of a drawback when it comes to building brands in plant based proteins. Building brands is just very hard, is one of the general conclusions. And where we're seeing more activity, I think precision fermentation in its broadest way is quite hot. There's quite a lot of support. There's quite a lot of interest. This is where we're making the exact same molecules that you would find in animals, but then without the animals. So we're talking the specific proteins that make dairy, and make cheese. And we're talking the fats that make meats that taste so good. So there's been a lot of pickup. And then there's also mass fermentation, which is where we're using microorganisms to upcycle food streams. So it's a very cheap and effective way to make proteins, and still you can be very, very precise about what you produce. So we see a lot happening there. We see a lot happening when it comes to electrification in the broadest way. So whether it's electrification of machinery, of electrification of fertilizer, which some might call industry, but nonetheless, precision fermentation, I think, has quite a direct case also in terms of cost efficiency. So farmers are, I think, more keen to adopt. So my question is, I guess, mostly getting closer to the consumer, right? What are going to be the winning strategies there?
Great, very interesting. And where do you see sort of the talent coming for these companies that are building in this space? I know that you're sort of one level removed from the actual
Yeah.
entrepreneurs, but in terms of your fund managers, and assuming that they're all sort of based in different parts of Europe or the US, um, do they normally sort of scout for this talent in universities and R&D labs, or are these sort of word of mouth, or from big corporations, people spinning out and starting companies? What's been the usual trend?
I think all of the above, right? So we need millions and millions and millions more people in climate, and they're coming, fortunately. So also when it comes to just the amount of people that want to work at our company is, I think we get 100 to 1,000 full times the applicants for every job that we have. I think a lot of people are finding their own motivation and reason to work for the climate or other goals they believe in, and they no longer see job as just a way to make money, but also as a way to have impact. So it really differs for the funds, I think, in terms of what stage they're in, how actively they're helping their companies find the right people. For the smaller companies, I'm sure they go more to universities and places they know. And for the larger companies, it's, I think, mostly C-level where they help. And other than that, companies have just become too big. So there, I'm sure that also different agencies will help them find the right people.
Right. Interesting. And then in terms of financing, so obviously equity is the one of the main sort of sources of funding on the venture side. But do you think some of these companies are also ready for philanthropic funding, for debt funding, and any kinds of other blended finance? And what do you think is the role of these alternate types of financing, kind of in climate as a sector, and how
Yeah.
big a role do you think it's going to play?
I mean, really important and across the capital stack, right? So I think there's grants and philanthropic funding that help companies get off the ground in their very, very first stages. We are an LP, for example, with Azola Ventures, who are also explicitly putting catalytic capital into those very first companies raising their very first rounds, who are maybe still a little bit too risky to be funded by the regular market. And then we're part of their, it's called full sleeve. So it's the second part of the fund that will also invest in that first round, but then in the follow-on rounds, and does target a market rate return. But I think they play a very interesting role very early on. I think both in North America and Europe, you see governments playing an important role in providing funding for innovative technologies for both the lab level, the research level, but then also first plant building. In the US, the Department of Energy has been funding also quite a few of the companies in our funds to build those first facilities that are just quite capital intensive and run those bigger pilots. And the same in Europe. So quite a few companies getting support from very various teams, whether it's innovation councils from the European Union or other. And then after that, we need to finance those first plants at scale. And I think that's everybody talks about it, right? It's the funding gap. It's the hardest part to fund because suddenly you need hundreds of millions, and you haven't proven that production at scale will be as effective. So there are quite a few interesting funds popping up that either say they're kind of just more patient capital than others, or slightly more risk taking. They call themselves catalytic, or really philanthropic funding to get those first factories built. Unfortunately, governments are also increasing support there. And then I think final part of the whole support stack is just also providing subsidies and financial incentives to buy these products. Uh, I think quite some technologies, including wind and solar and batteries, are proving that they can get to cost parity and beyond. But it requires quite a bit of skill before we hit that cost parity. So even for that early adoption of technology, I'm very happy that we're putting some money in.
Yes, no, absolutely. That's a very comprehensive, I would say, summary of the capital stack. And it's
Was
exactly
that
as you
also an
say.
answer to your
Um,
question?
no, it was actually great because this is as a sector. I mean, if we want to avoid the mistakes of clean tech 1.0 and the bubble that burst, 15 years ago, we have to make sure that we have as diverse forms of capital coming in to underwrite the risk of these early technologies. And especially, like as you said, these greenfield projects, which still need to be proved out, important that we get early believers in. And then also for the eventual customer, how can they eventually be convinced that paying a green premium is going to be worth it? So I think that's a really important consideration, and great to see that your funds in your portfolio, like Azola Ventures, are starting out to sort of integrate catalytic capital in their in
Yeah,
their portfolio companies from
yeah.
the very outset. Yeah.
That's one thing that I would love to see more. So I think Azola for me is one of the few funds that is combining the catalytic and patient capital that's available with the market returns focused capital in the market, including ourselves. I'm actually talking to quite a few larger family offices where I just think it's fascinating that they have like their foundation and their philanthropic activities, and then they have their investment activities, but they're not always integrated and kind of reinforcing each other. And I think there's a lot of opportunity to make sure that all of the efforts that are happening are pointing in the same direction and building on each other.
Yeah, absolutely. That makes a lot of sense. And with a lot of these families, family offices that potentially come in, to be LPs, are they also expecting, obviously the dual financial return? So you have your commercial financial return and or dual bottom line, as it were, double bottom line, and then the rest is sort of the social and environmental, return as well. So how do you kind of measure? I know that you look at impact within carbon equity. What are sort of some of the matrices that you use to measure return on investment from an environmental angle or from a
Yeah.
decarbonization angle?
We're in the middle of it. We're in the middle of figuring this out. Currently, we don't measure in that way. So I think I spend a lot of time thinking about what is it we're really trying to achieve with the capital, and how do we show that we're doing the right things. And it starts with financing the right technology and business model, those companies that are most important for net zero. So that's the most important thing what we do with regards to tracking our portfolio and also reporting to our customers. For every company one of our funds invests in, we assess how important we think this company can be for net zero. And we say it has no, some, or substantial potential, or substantial, let me say that again. It has the potential to have no, some, or a substantial contribution to net zero. We really talk about the contribution net zero as being, is it solving a large problem? And is it solving it deep enough that it's net zero aligned? So that's what we do for all of our companies. I think Fund 1 is tracking at 92% substantial net zero investments. Meaning we're funding the right stuff. And then the second question is that stuff scaling, right? Because if you're funding the right technologies and then those technologies are scaling, then I think you did your job well. And there we're still trying to figure out, is that just financial metrics, or do we then also want to translate that into an impact number? I think we have really high conviction that I would love to start reporting on what I call the unit impact. So we say this technology is 90% lower carbon emissions than the market alternative. And then it's very important to show that that technology at some point starts scaling. But to make the actual calculation and to say, okay, so we sold 1,000 products and they're 90% lower carbon impact, so the carbon impact is Y, that's actually not underwritten by accounting standards, and there's various challenges in there because you are assuming that you're displacing one of those other units for every unit you sold. So maybe a little bit technical, but we're still in the middle of figuring out like how many calculations do we want to do on top of the data where we have high conviction in, and to what point are those calculations then still valid enough in our eyes?
Interesting. So, would part of it also include the metric tons or gigatons sort of displaced from utilizing
Yeah,
a particular zero carbon technology versus a
yeah.
fossil fuel technology? Is that something you've also considered?
Yeah, so we're
Yeah.
considering it, but so
Hmm.
far we have decided not to do it. So we talk
Hmm.
about the unit impact of a company, and we talk about whether they're gaining economic success, but we're not reporting this one carbon number for our entire portfolio.
Understood, understood.
Yeah,
Interesting. And I like
yeah,
the rationale for that as well. It is something that, you have to see how well the company is scaling also
yeah.
and see whether that the financial metric should really measure that or should it be another metric. Um, and that's interesting. And has that also, kind of, would you say that you're sort of fairly restricted to companies only then that have that environmental, like the decarbonization piece, or would you also look at companies or rather funds that invest in water technologies that maybe don't have a carbon angle or any other
Yeah.
sort of sector?
Yeah, so we're decarbonization first. That is our key goal. And it's also, I think, very important for our LPs that we're just very clear about we're optimizing for decarbonization. We're doing everything that we can in this fund to contribute as much to stopping climate change as possible. We do commit to funds that either have a broader impact mandate or are quite focused on multi impact, so to say. So next to decarbonization impact, also achieving other types of impact. We can invest in the broader impact funds, maybe sometimes in a specific vertical like agri-food. A general impact fund makes more sense than only decarbonization. So there we can see it happening. And sometimes there's just this amazing team that is, I don't know, nature positive focused. And we look at their portfolio and we think there's enough decarbonization in there for us. But we do assess the relative focus on decarbonization versus other impact themes for each of these funds. And generally, we need to see at least 60-70% decarbonization focus to get comfortable.
Got it. Understood. And then what is your sort of thought process or strategy towards other regions beyond North America and Europe? I know we have briefly
Yeah.
discussed this,
Yeah.
but yeah, it would be great to understand your thought on, which markets do you think have potential if you were to widen the platform and look at it, for example, Asia, Africa, Latin
Yeah.
America.
Yeah. Yeah, I'm not sure if I can answer that last question already. For that, we really need to do more work. But so we're focusing in North America and Europe when it comes to the fund managers. Some of these fund managers are investing in, have a global investment mandate. So there are some companies in our funds that are in global south or other parts of the world. The reason we're focusing on European North American fund managers, first of all, is we really want to understand the landscape before we invest. We really want to know what options are out there, how they stack up one against the other before we choose a specific one. And it just made a lot of sense to start in our home market to build that landscape. So by now we know of 450 funds in those geographies, and it's taken us 2 years to build that database. And still, from time to time, new names pop up. So generally, VC fund landscape, PE fund landscape, it's very intransparent. So you need to build your database LP to LP. And we're quite advanced now in these markets and really know which kind of managers we like and where we want to commit. So it's creating a little bit more room for kind of like, what is our next project? We thought, is it going to be new geographies or is it going to be a new asset class? For now, we're prioritizing a new asset class. So that's climate infrastructure for various reasons. When it comes to other geographies, I'm talking to fund managers when I can just to start creating a picture because I don't have a very good picture yet, both of the opportunity and of who's operating in it. I think I've spoken to, just incidentally, but to some really interesting funds in India, I think more broadly Asia, Singapore, China, we really have a very limited view of so far. I will say Latin America and Africa is a little bit more quiet, but whether that's due to my network or general activity in the space, I don't know. And I think there's also just an interesting question of local investors versus let's say, the leapfrogs of this world that are also raising big emerging markets funds. So that's also something that we're still figuring out. Who do we want to support in those geographies?
Yeah, absolutely. No, makes sense. I think in sort of this global south area, and it's actually quite encouraging to see that the latest two COP conferences have been
Yeah,
in, the global south, so Sharm el
yeah,
Sheikh and the UAE, and then next year or this year it'll be in Central Asia. But there is a lot more focus on how to sort of translate
yeah.
the sort of large dollar capital coming from the north and make sure that it reaches a lot of these adaptation resilience projects that are happening in the global south. So interestingly, in India, which is a market that we operate in, there is a huge host of talented climate tech entrepreneurs and early stage capital that is available to fund them. But I think the gap that we have really is in the growth capital area.
Mm,
So sort of Series B plus. I think what usually happens is that funds, or rather companies, end up raising from international funds, for those larger tickets. And then we also have, the PE and the late stage growth equity, or rather pre-IPO capital in India, but that hasn't really, started looking at climate. It's more sort of other, sectors that are more familiar. So I think we're in the nascent stages, but I think it's with plenty of early stage activity and evangelism, for this particular space. I think we're starting to see a lot more, of the path to further capital raising and growth happening, and more growth equity funds hopefully starting up in India too, and from abroad. So great to hear that this is an area that or a region that potentially you could consider after you've sort of looked at new asset classes and other sort of segmentation, because I think it has a lot of opportunity and a lot of different types of sectoral strength. For example, food and agri here, India being the second largest
mhm,
cultivator after the U.S. A lot of interesting innovations happening
yeah.
on the land pre-harvest space as well. So yeah, that's on that piece. I think just a few other questions I wanted to kind of ask before we close. One is, and we should have covered that in the beginning, is your personal journey into the
Mm,
space. What sort of excites you about climate? I know that you spent some time at McKinsey, also in the energy transition, kind of vertical. So did you kind of do any interesting projects with corporates at McKinsey, or how did you come about sort of getting completely focused on climate as a space?
yeah, yeah. Very happy to answer that. So, once upon a time, I was a political scientist in university, and I think I've always just been keenly interested in positive forces. Just where's the power for change? Where are the instruments and the things that can really make a difference? And I landed on impact investing. I was money changes the world. So how is money changing the world for the better? I spent a year researching how impact investing works in public markets, how you can then make a difference there. As said, the conclusion is just really, really, really hard to have impact in public markets. And my other big passion was climate and the energy transition. So decided to jump ship, join McKinsey, and just continue to build up my knowledge as I was helping clients. I think I got really lucky there. I was in Amsterdam where two big internal energy transition teams were working. So one is the global energy perspective. They're literally building, just forecasting the speed of the transition under different scenarios, and then using those models to advise clients on their long-term strategies. So there, for example, I spent a lot of time really understanding the fundamental drivers of electric vehicle adoption. This was, mind you, 5, 6 years ago. And the speed of adoption that we were predicting was hard to take seriously, right? You look at the beginning of this exponential curve, and once you start throwing that out, everybody goes like, "No, that's nuts." So I spent a lot of time really building the case from different viewpoints why our predictions were not nuts, and to then help those for OEMs in Europe to actually tell them, if you don't start building electric vehicles soon, you're going to miss out on this massive opportunity. 5 years later, we see that electric vehicles are the only growth market left in automotive industry. And our predictions were far below actual adoption rates. So it was a fascinating time to start understanding how quickly adoption can go, and to then use those forecasts to try to, yeah, help the big industry players think about when and where and how they should start anticipating and responding to those early trends. And then the other team is called Sustainability Insights, and they really build decarbonization pathways, as they're called. So I would say the difference, global energy perspective is more forecasting. So where are we now? Where are we going? And then Sustainability Insights is more backcasting. If we want to be carbon neutral in 2050 and stay within 1.5 degree carbon budget, when do we need to start doing what? And so there I also helped on different projects. And the most exciting one was the Europe Net Zero, where really for the European Union level, we drew out what a 1.5 degree pathway would look like. So those were the internal projects, and all of that knowledge we brought to clients and helped them transform, or at least think of their strategies to do that. So it was a fascinating time. I got spent a lot of time in different little niches, right? You dive in for 4 weeks in what does like sustainable home heating ecosystem look like, and then you're on to like, wait, how does plastic recycling work? So learned a lot, and quite frankly, the whole role of capital, it continued to nag me. I was like, I'm really happy that we're helping these corporates transform, but there's this other piece of the pie, which is the financial market, and at least in the parts of McKinsey I was operating, there was not as much attention for that. So I was kind of at a crossroads where either I tried to start building this within McKinsey, and I spend my time and energy on that, or I tried to build it for myself. And around that time, I met 3 amazing co-founders, and we were so complementary in our skills, and we were all like, okay, let's get capital moving. So decided to venture out, and now we're here.
That's extremely interesting, and great to hear your journey, how it sort of came to this point. Which sort of leads me to my next question: is when with the co-founder group as it is, what is sort of the makeup of the skill set? So you have the sort of the impact investing, well, the consulting background,
Yeah.
and do any of your co-founders also have a something complementary in the sort of financial skills or venture capital, private equity, or even starting businesses?
Yeah, very much so. So let's see. There's Lara Cola. She brings the deeper financial track record. So she was first at Deloitte doing a lot of corporate M&A advisory, and then building a startup support practice. And then she moved on to Philips, where she was one of the founders of the Philips Ventures program. So she did a lot of VC investing there, more in the health segment, but for over 5 years. Then Jacqueline van den Ende, she's our CEO. She brings kind of like a mixed combination of both investing and an entrepreneurial background. So on the investing side, she started at one of the bigger private equity houses in the Netherlands, her career, and then moved to actually to the Philippines, where she led 2 different businesses, really built them from the ground up. I think both went from like 2 to 100 employees. So she has quite a lot of experience scaling ideas and teams. And then Jeff is I think we still call him our CPO, but he also leads our tech team. He has a lot of entrepreneurial experience as well. So he was at different sustainable startups and scale ups in marketing and product roles. It's really figuring out exactly what it is our customers want and how we can tailor our product as much as possible to them.
Interesting.
It's quite fun. It's a really diverse background, and I think both in skills and personalities. And it's one of the things that makes it a lot of fun and sometimes a little
Yeah.
bit challenging.
Oh, of course. It sounds really exciting, actually. And you all operate in Netherlands, is that right? Or
Yeah.
are you sort of dispersed across? Okay, so you're all in the same place. Yeah.
Well, so yeah, I mean, we're so far, most of us are based in the Netherlands. We have a few people in our commercial team in Belgium, which was the second geography we started operating. Right now,
Hmm.
quite a few of the team is in Germany because we're starting
Hmm.
to build our commercial operations there. So it's starting that we're becoming multi-office, but so far it's been really lovely to be in the same place physically. We haven't figured out how to be a fully digital company yet.
Yeah, that comes with its challenges also. Great. So I think as we're just about to close, I mean, I just had a broader question to throw out there. If you had to look ahead, like sort of 5 to 10 years in the future, where would you like to see, the venture ecosystem and funds operating in this space? Potentially even regulation, the consumer mindset. How would you? I mean, given that we are operating on a fairly urgent timeline of trying to achieve net zero, at least for a developed world by 2050, and for countries like India by 2070. And there's a whole bunch of mandates by 2030, which is in the next 4.5 to 5 years, rather 5 to 6 years. What would be your sort of top three or sort of wish list of what you'd like to see evolve?
Oh, just the top three. I mean, one is definitely for governments to stay in their current trajectory. I think they've increased support so much. Let's hope that doesn't fade, and let's hope they continue to build in that side. Certain elections will make that a little bit challenging, but very much hoping for the government support to stay there. Secondly, I think consumers are increasingly in more and more dimensions of their life, understanding climate tech. So home decarbonization is very hot. I hope that, well, also for us on the investing side, they continue to build awareness what they can do with their money. And in all of their other consumer choices, including agri-food, that they, get even more motivated to help where they can. And when it comes to the capital stack, I think we're moving in the right direction, right? It's a little bit of a challenging time in the market, but we see climate tech being more resilient than other industries. Let's hope. I think I mostly hope that we integrate even more, right? There's a lot of capital available for different parts, but that's we either within one fund or two different funds working together to get the equity and the debt piece of that first factory just completely together. And then there's a public sector part to it as well. So let's get even better at integrating all of that.
No, absolutely. I couldn't agree with you more. And I also am hoping that there's a lot more activity on the fund allocation side, more capital coming in, and then more entrepreneurs, to actually
Yeah,
build these,
it's a good point.
technologies.
Are you
Yeah, that.
opening more LPs for funds? Mostly just more capital for
Mhm.
these funds? Yeah.
Yes, yeah,
Yeah.
that's right.
So
Yeah, more people getting converted to know that this sector is a financial opportunity rather than something that may not be able to make money. It's quite the opposite, actually.
yeah.
So I think,
At least in Europe, we see a lot of positive momentum there. So we see increasingly family offices either they're impact motivated and that's how they find the space, or it's just a trend they don't want to miss out on. And we're very happy to host both. But increasingly, also the latter group shows up. So I think more and more family offices are stepping in. I really wish that pension funds will continue to step up. At least in Europe, those are very big capital pools. Some of them are doing more than others in climate. And let's hope also just that public markets recover a bit, because at least in Europe, a lot of institutional investors have this fixed share of their portfolio that they want to allocate to private equity. And as public markets have come down, they're suddenly overexposed to private equity. And so there's a little bit of a freeze happening there, which is, I think, also what we've seen reflected in total fund rates. So, yeah, let's hope that they also find more money to deploy.
yeah, absolutely. No, so plenty of things to check in 5 years' time, where we are at.
Let's write these down
Yeah,
on a napkin, and 5 years from now, I'll give
exactly.
you a call to see what
Yeah, it'll be a good test. But no, for now, thank you so much, Liza, for your time and for all your perspectives and insights. Really, really happy to have you here, and we hope to invite you back. And good luck with all the fantastic work that you're doing at Carbon Equity, and we hope to collaborate with you in the future as well. So thank you once again. Really
happened.
appreciate it.
Thank you a lot, too. It was a great conversation.
Thank you.